There's a property I looked at a few years back. Solid neighborhood, good market, numbers that looked clean on paper. Rent covered the mortgage, the price was fair. On the surface, it had everything. I pulled the comp myself. I walked the property, ran the cash flow analysis. And then I asked one question, the last question I always ask before I commit to anything. And the deal was dead in 60 seconds. The question isn't about the price. It isn't about the neighborhood. It comes at the very end of a specific sequence. In this video, I'm going to walk you through all 7 questions in the exact order I use them. By the end, you will know which question killed that deal and whether the properties you are looking at right now would survive it. If you don't know me, I own 23 rental units, 5 million in real estate, 404,000 in rental revenue last year from about 1 hour of work a week. This is the exact checklist I wish someone handed over to me when I get started 10 years back. Most investors make the same mistake before they ever look at a property. They open Zillow, they find something they like, they run a rough cash flow number and decide it's time to move. What they skip is the sequence that determines whether the deal works in year 1, year 5 and even year 10. After 10 years of investing, I have developed a 7 steps checklist to get rid of bad deals. Each one of these is based on a real scenario. And each one is stopped by one of these 7 questions if you ask it before you buy. So what is the question 1? Is the market growing? Real estate investing starts before you ever look at a single property. It starts with the market. A good property in a shrinking market is still a bad investment. When I was building my portfolio, I didn't start in my backyard. I looked at where people were actually moving, where jobs were growing, where vacancy rates were low. That's how I ended up with properties in Nebraska, Alabama, Ohio, and Tennessee. None of those were obvious choices. But when I looked at the data, population growth, employer expansion, rental demand, they kept coming up. Markets with growing populations pull demand toward you. You are not chasing tenants, they are coming to you. Weak markets work the opposite way. Rents stagnate, vacancies climb, the tenant pool shrinks, and you are competing harder for fewer renters. So, 3 things to check before you look at a single listing. Job growth over the last 3 years, net population change in the metro area, average vacancy rate for single family rentals in that zip code. If all 3 are moving in the right direction, the market passes. If any one is going the wrong way, move on before you waste time on individual properties. A growing market gives you the demand, that's the starting point. But even a market with strong demand can become a financial trap. Most investors spend weeks researching zip codes and zero time on the next filter. It has nothing to do with the property itself and it determines what happens when a tenant stops paying you. Here comes the question number 2. Is it a landlord friendly state? You can find a great market, run the cash flow, buy below value and still get wiped out by a single eviction in the wrong state. Because the state you invest, it determines what happens when things go wrong with a tenant. In Tennessee, a landlord issues a 14-day notice to pay or vacate before the eviction process begins. That's the standard timeline in a landlord-friendly state, measured in days and weeks, not months. But what happens in a tenant-friendly state? That same situation, a tenant who stops paying can take 3 to 6 months or more to resolve through the courts. 3 to 6 months of carrying the mortgage, the taxes, the insurance with no rent coming in. And I have seen investors with cash flowing properties on paper get wiped out not by the market but by a single eviction in the wrong state. What's actually happening in a tenant-friendly state is that the legal system slows the process down by design. Every step has a waiting period. Every notice has a response window. The cash flow model you build assumes a tenant is paying. When that assumption breaks, the recovery timeline is what determines whether you survive it or not. So before you look at a single property in any state, look up the eviction timeline for non-payment of rent. Texas, Florida, Alabama, Indiana, Tennessee. The process moves in days to weeks. A state with a timeline measured in months rather than weeks changes your risk profile entirely. Factor that exposure into your decision before you fall in love with a property. Pick the state first, then find the property. The right state shortens your recovery window if something goes wrong. That's your protection. But protection alone doesn't make a deal profitable. The next question determines whether the property makes money from the moment a tenant moves in. Most beginners look at gross rent and assume most of it is a profit. The next filter that shows you what you actually keep. By the way, if you want my help running these 7 questions on an actual property, finding the right market, the right estate, and a deal that passes every filter, I work directly with first-time investors inside my mastermind program. I help people like you build a cash flowing portfolio in 90 days without quitting your job. The link is in the description below to book a free 15-minute call with me. The next question is whether the specific property makes money from day one. Not eventually, not after appreciation, from the day a tenant moves in. And the filter is called the 50% rule, and it takes about 60 seconds to run. Take the gross monthly rent, cut it in half. That half covers taxes, insurance, vacancy, repairs, and property management. What's left is your net operating income. Subtract the mortgage payment. If what remains is less than $200 per door, I don't spend another hour on that property. I ran this on a 3-bedroom in Ohio a few years back. Gross rent was $1,100, so net operating income was approximately $550. Mortgage was $620. That's negative $70 per door before anything goes wrong. Close the tab in under a minute. The reason this filter matters so much is that most beginners underestimate expenses. Vacancy alone at a conservative 5% eats into the number first. Add a repair month, a management fee, a property tax bill, and a deal that looked profitable on gross rent is suddenly bleeding money. The 50% rule forces you to be honest before you get attached to a property. Here are the steps you can follow. Calculate the gross rent times 0.5 minus mortgage. If it clears $200 per door, go deeper. Get actual insurance quote, pull the property tax history. Call a local property manager for real vacancy numbers specific to that zip code. If it doesn't clear $200, close the tab and move to the next one. Positive cash flow from day one. That's the filter. But a deal can pass the cash flow test and still be a mistake. The price you pay on day one determines your margin of safety for everything that follows. Pay full market value and you need everything to go right. There's a formula that builds in a cushion before a tenant ever moves in. Here's how it works. The next question I ask myself, are you buying below the market value? A property can cash flow and still be a bad deal if you pay too much for it. Because the price you pay on day one determines your margin of safety for everything that comes after. Dean Graziosi makes this point in his book, Be a Real Estate Millionaire. Your profit is made at the buy, not the sell. If you pay full market value, you need everything to go right. Rents have to rise, appreciation has to come through, vacancy has to stay low. But what happens? You buy at a 15 to 20% discount and you have locked in a cushion before a single tenant moves in. That cushion is what lets you absorb a bad month, a surprise repair, or a market dip without it threatening the investment. The formula is called the 70% rule. Take the after repair value, what the property is worth once it's in good condition. Multiply it 0.70. Subtract your estimated repair cost. That number is your maximum offer. Anything above it and your margin starts to disappear. Anything below it and you have got room to breathe. So here is your next step. At first, pull 6 months of closed comparable sales to establish the ARV, not active listings, closed sale. Work the property with a contractor and get a written repair estimate. Apply the formula ARV times 0.70 minus repairs. That's your ceiling. Submit offers below it. On different properties, I have negotiated between $10,000 to $60,000 below asking price using this exact process. The asking price is always negotiable. Your formula isn't. Buying below value locks in your caution before the deal even starts. But the purchase price isn't the only number locked in at closing. The loan you sign determines whether inflation works for you or against you for the next 30 years. Most investors pick the wrong loan type and don't realize it until rates move. Here's what to use. Question 5: is the financing fixed? Once you have found the right market, state, property, and price, the loan you choose determines whether inflation works for you or against you for the next 3 decades. When rates dropped below 3% during the pandemic, I refinanced 4 properties. On each one, the monthly payment dropped. Across all 4 properties, that was hundreds of dollars in additional monthly cash flow. Not from new tenants, not from raising rents, just from locking in a lower fixed rate. That's what a 30-year fixed mortgage does. It freezes your biggest expense while everything around it inflates. Rents go up over time, your mortgage payment stays exactly the same. The gap between those two numbers is where your cash flow grows. An adjustable rate mortgage, ARM, does the opposite. When rates rise, and they do, your payment rises with them. A deal that was profitable at purchase becomes a deal you are subsidizing every month. So here are the 2 loan types I use all the time. 30-year fixed conventional for standard purchases. DSCR loans, debt service coverage ratio, qualifies based on the property's rental income rather than your personal income, which makes it useful as your portfolio grows above 10. Always avoid adjustable rate mortgages. Avoid short-term commercial loans with balloon payment. If the only financing available on a deal is variable or short-term, that's a reason to walk away. Good financing gets you into a property. Reserves are what keep you in it when something goes wrong, and something always goes wrong. This is the question that catches investors who have done everything else right. They close on a solid deal, cash flow looks good, and then a tenant leaves. Without these in place, they are covering the mortgage out of pocket with no buffer. Here's the number you need before you close on anything. Here comes the question number 6. Can you survive vacancy? Good financing gets you into a property. Reserves are what keep you in it when something goes wrong. Robert Kiyosaki outlines the core principle in Rich Dad Poor Dad. Good debt is debt where the income covers the payment. You can absorb vacancy without defaulting, and the asset builds both equity and cash flow simultaneously. If all 3 are true, the debt is working for you. If anyone is not, you are carrying more risk than the deal is worth. The vacancy question is the one that catches people. They run the cash flow, they like the numbers, they close on the property. What happens after? A tenant leaves, a repair comes up, and they are covering the mortgage out of pocket with no buffer. That's not a bad market. That's the undercapitalization. The property was fine, the reserve wasn't there. So here is my rule. $5,000 in reserve per property, held separately and not touched for anything other than that specific property. Before you close on any deal, that reserves need to exist, not after you close, before. So here are the steps to follow. Run 3 questions on every deal. Does income cover the mortgage with cash left over? Can you survive 3 to 6 months of vacancy? Does the asset build equity and cash flow at the same time? If the vacancy questions makes you uncomfortable, build the reserve fast or don't buy yet. The deal will still be there when you are ready. Every question up to this point filters out bad deals. This last one filters out the wrong mindset. And it's the question that killed the deal I mentioned at the very start. That property I walked away from, good market, cash flow, priced right, landlord friendly state, fixed rate financing, reserves in place, it passed every question. And then I asked myself the last one, am I prepared to hold this until it doubles in value? Honestly, I wasn't. The area had long-term uncertainty I wasn't comfortable with. And if I couldn't commit to holding it for 10 to 20 years, I had no business buying it. Because selling early is where the compounding stops. John Scabb has invested through 6 recessions and interest rates ranging from 3% to 16% over his 50 years career. His book, Building Wealth One House at a Time, makes the case clearly. Buy intending to hold until the property at least doubles, which, based on National Association of Realtors data, takes approximately 15 years at historical appreciation rate. Keep 6 months of reserves, so nothing forces you to sell early. 4 things run simultaneously when you hold. Tenants paying down your mortgage principal every month. Rents rising while your fixed payment stays flat. Property value appreciating across market cycles. The option to roll gains into a larger asset tax deferred through a 1031 exchange. Selling early turns off all 4 of those engines at once. My 23-unit portfolio is worth $5 million today because I held it. The tenants paid down the mortgages, the rents went up, the fixed payments stayed flat. That gap compounded for years. So before you make an offer on any property, ask yourself one question. Can I see myself holding this for 15 to 20 years? If the answer is yes, run the other 6 questions. And I intend to hold all of my 23 properties for the next 2 decades. It's the compounding you give up when you sell before the wealth has had time to build. That's the question that killed the deal. And it's the one that's protected every deal I have made since. And if you want to go deeper, how to find these properties, how to analyze markets, how to build a portfolio that generates consistent income, that's exactly what I cover inside my one-to-one program. The link is in the description below. Happy investing, and I will see you in the next video.